Here we're going to be looking at a partnership liquidation here where we're terminating the business and distributing the assets using the right of offset with common law here. This is the key here. We're going to be using common law. There's a twist here. We're not going to be using the Uniform Partnership Act. So first let's look at our right of offset and what we're talking about here. We have a capital account here for partner B, and he has a deficit amount here of $28,000 in the capital account here. And the partnership here is a loan payable to partner B. Partner B has made a loan to the partnership here for $10,000 here. So partner B is due $10,000 here from the partnership on this loan here. So what we do for the right of offset here is we close out this loan payable here. In this case we would take and debit it for $10,000, and then we transfer it over here. We'd credit the capital account here for the partner B here for $10,000. And in doing that, we reduce this deficit here from $28,000 less the $10,000 from that note payable here. We come up with a deficit amount here of $18,000 for partner B here. So he still has to owe $18,000 here to the partnership. So let's go here and look at how we apply this right of offset to our personal assets that would be distributed, assuming common law is applied here. So let's look here first. We've got partner A and partner B here. So we have the let's look at partner A first here. So this is straightforward. Assets of $60,000, liabilities of $30,000, and then the net personal assets here would be $60,000 less the personal liabilities here of $30,000. So we have a balance here in their asset account here of $30,000. Now they don't have any deficit in their capital account. Matter of fact, if we look at their capital account up here, it has a credit balance here of $40,000. So partner A is straightforward here. Now let's look at here at partner B. They have assets here of $44,000 and liabilities here of $42,000. Now we've applied this loan asset offset up here, so we'd be reducing here our loan offset here of $10,000. We'd subtract that from the beginning balance of the assets here, $44,000, and come up with the net personal assets here of $34,000. So now our key here with the common law is we have to calculate these personal liabilities that we can subtract here from the net personal assets. We have a liability amount here of $42,000, but we have to go in and we're going to calculate this personal liability here at to be $23,800. So let's go down and look at how we do that. Now first off, the amounts owed to partners by the way of a contribution or a deficit in the capital account here are on an equal basis with the personal creditors of the partner based on common law here. So the personal creditors plus the partner's deficit account here on an equal basis. So what we have to do is we have to go and we have to calculate our personal asset allocation here. So for partner A, we have our payable to personal creditors here of $30,000, partner B payable to the personal creditors here of $42,000. Now we have a payable to the partnership for that debit capital balance. Now with A, they had a credit capital balance, so there's no deficit there, so it's zero here, but partner B has an $18,000 debit balance or deficit balance in their capital account. So what we do here is we add up the payable to the personal creditors plus this payable to the debit capital balance here, $42,000 plus $18,000 gives us a total amount here of $60,000 that we'd have to allocate. So let's go and look at how we'd allocate here. So the percentage of the net personal assets available to the personal creditors would be the $42,000 here divided by the total amount here of $60,000. That gives us 70% here. So we can allocate 70% of this $34,000 that we have our net personal assets here. So 70% of that gives us $23,800. So that's what we would be including as our personal liabilities here in common law, $23,800. Now we could go down here and look at just another way of calculating that here. So we're looking at the $18,000 here in the debit balance over the total amount here of $60,000. So that 18 over 60 gives us 30% here. 30% times that net personal assets here of $34,000 gives us $10,200. So that we'd move up here, and that would be $10,200 $200 that we could contribute here to the capital deficit here. And it would be the same here as subtracting out the $34,000 net personal assets less the personal liabilities that we allocated here at $23,800. That would give us $10,200. So let's go over and look at our partnership here. So again, A's capital balance, they had a positive amount here of $40,000, but B's capital balance here had a deficit, started out with a deficit here of $28,000. Now we allocated, or that applying that loan offset here, we've reduced this $28,000 by $10,000, so we come up with $18,000. So what we would do here is we can further reduce this $18,000 deficit here by taking this amount that we can apply to our capital deficit here of $10,200. So we could move that over here and we could apply that to our deficit here. So we would subtract the $10,200 here from the $18,000, and it would give us $7,800 that's remaining in the partner B's capital deficit account here. They still owe $7,800. Now if we go down here again and look at this balance here, it's at zero here for the assets for partner B. That's only because we still have a deficit here of $7,800. So we've applied the $10,200 here to the $18,000 that was sitting there in the deficit for the capital account here for partner B after we applied the loan offset here of $10,000, or the right of offset here for the loan of $10,000. So here's what we got here. We end up with $7,800 here in the partner B's capital deficit account. If we move over to their capital account here for partner B, you can see that we had the $28,000 deficit here, and then we had that credit amount here for the right of offset here for that loan of $10,000, and then we also were able to credit it here for the further contribution to that capital deficit here for $10,200. So the net amount that we're sitting at here is $7,800. Now that's where we use the common law instead of the Uniform Partnership Act here. So this is where we use the common law, and then again we went over and we had to allocate these personal assets here between the payable to the personal creditors that we had amount here, and then the payable to our debt capital balance total amount here. We would add those two together here, and then we'd be able to allocate here as we did here for our percentage of net personal assets available to the personal creditors here. We determined that to be 70% here, and that's all based on the fact that the amounts owed to partners by the way of the contribution or the deficit in the capital balance are on an equal basis with the personal creditors of the partner based on common law.